Welcome to Future Finance Insights, where we break down the trends shaping tomorrow's wealth. From AI stock movements to global market shifts, we turn complex financial data into simple, actionable insights you can use right now. Let's dive into today's topic. Is the AI stock bubble about to burst? What investors should know. Artificial intelligence has become the center of the financial world. AI stocks have exploded beyond expectations. Chip makers, cloud computing giants, and AI software companies are reaching new highs almost every quarter. Every headline talks about new breakthroughs, new AI tools, and trillion-dollar predictions. But recently, something has changed. Traders, analysts, and even long-term investors are beginning to ask a serious question: is the AI boom becoming a bubble? And if yes, what should investors be doing right now to protect themselves? In this video, we'll break down exactly what's happening in the AI market, the warning signs analysts are seeing, the risks behind the hype, and the smart steps you can take to navigate the uncertainty. The first thing viewers need to understand is what pushed AI stocks so high in the first place. This growth is not random. It's tied to a powerful combination of technology, business adoption, and massive investor excitement. Over the past 2 years, companies across every major industry — finance, healthcare, retail, logistics, transportation, and even government agencies — have been aggressively adopting AI tools to reduce costs and improve efficiency. Many of these tools automate tasks that once required large teams of employees. That creates enormous profit potential. At the same time, the hardware behind AI, GPUs, advanced chips, massive data centers, became one of the most demanded technologies on the planet. This created explosive revenue for chip makers and cloud companies. On top of that, retail investors flooded the AI market with money, hoping to catch the next big wave. And of course, the media played a major role. When people hear that AI is expected to add trillions of dollars to global GDP, excitement spreads. Hype spreads. And when hype spreads, prices run far ahead of reality. Now let's talk about the warning signs. Because while AI has massive long-term potential, there are clear signals that the stock market may be overheating. The first major warning is that AI stock prices are rising much faster than their actual revenue. In other words, companies are valued as if they are making far more money than they actually are. This is one of the strongest early indicators of a bubble. Another warning sign is that the entire AI ecosystem leans heavily on a few major players, especially chip makers. If demand slows even slightly, or a competitor releases a more efficient product, the sector could be hit with a sharp correction. We also have to consider the adoption gap. While many companies are experimenting with AI tools, only a small percentage have fully integrated AI into their operations. This means revenue expectations may be far too optimistic. And of course, recent market volatility is a sign investors are becoming unsure. Some AI stocks have dropped 15 to 25% after earnings, even when the results were strong. That level of volatility suggests big players are nervous. Finally, AI development costs are insanely high. Companies must spend billions on servers, chips, energy, and data. If those costs outgrow revenue, valuations simply cannot hold. So what happens if the AI bubble pops, or even slightly deflates? It doesn't mean AI disappears. It doesn't mean the technology stops advancing. What it means is that stock prices begin to fall back toward more realistic levels. Overvalued or hype-driven companies would likely take the biggest hit. Smaller companies that rely on a single AI product or service could drop fast, especially if their revenue isn't strong enough to support their valuation. But the major players, the ones with solid revenue, strong customer bases, and real adoption, would likely recover after the correction. A market correction simply resets valuations. It forces investors to focus on real long-term fundamentals instead of hype. It slows the frenzy, but it does not stop the AI transformation. People need to understand, the long-term future of AI is still extremely strong. A correction only clears out the excess. Let's talk about what investors must understand before making any moves. First, not all AI companies are equal. Some are building game-changing technology with real industry demand. Others are simply adding AI to their branding to attract investors. You must know the difference. The second thing is that volatility is normal in a fast-growing tech sector. If you invest emotionally, you will lose emotionally. The AI market moves quickly, sometimes too quickly for inexperienced investors. Third, don't rely on hype. Rely on fundamentals. Companies with strong recurring revenue, proven customers, and real profitability are the ones that survive corrections. Fourth, keep in mind that major regulations are coming. Governments in the US and Europe are working on AI rules that affect data use, privacy, and security. Any regulation could impact company growth and stock valuations. And finally, diversifying your investments is no longer optional, it's necessary. Putting all your money into one AI company, or even one category, is a dangerous strategy. Let's go over the smartest steps investors can take right now. The first strategy is to focus on companies with real fundamentals. That means companies with strong balance sheets, real customer demand, diversified AI solutions, and the financial strength to survive a downturn. The second strategy is simple but important. Avoid chasing hype spikes. When a stock jumps 30% in a few days because of social media buzz or a viral headline, resist the urge to chase it. These spikes often fall back. The third strategy is to consider AI-focused ETFs. These funds give you exposure to multiple AI companies at once, reducing your risk if one stock crashes. The fourth strategy is to invest slowly and steadily. Dollar cost averaging, buying small amounts over time, keeps you from making emotional decisions. And the fifth strategy is to think long-term. AI will transform healthcare, education, cybersecurity, finance, transportation, energy, and more. But this transformation will happen over years, not weeks. Long-term investors benefit the most. Here's the bottom line. The AI market is powerful, innovative, and full of opportunity. But like every major technological revolution in history, it comes with volatility, hype, and corrections. Whether the AI boom is a bubble or simply overheated doesn't matter as much as how you approach it. If you educate yourself, diversify your investments, avoid hype, focus on fundamentals, and stay patient, you'll be positioned to take advantage of the long-term growth. AI is bigger than a trend. It's a global shift. But smart investors don't follow the noise, they follow the strategy. If this video helped you understand what's really happening in the AI market, don't forget to like, comment, and subscribe. Thanks for watching Future Finance Insights. If you want more clarity on the markets, investing strategies, and the future of money, subscribe and turn on notifications. See you in the next episode.